Welcome. This is a brief introduction to individual retirement account. At the end of this brief presentation, you will have a chance to try your hands on some real life scenarios. So you guessed it right. We're going to talk about retirement planning, correct? So live your life to the fullest by planning for your retirement days. Financial security in retirement does not just happen. It takes planning and commitment, and yes, money. Putting money away for retirement is a habit we can all live with. Remember, saving matters. Your retirement income will likely come from two, possibly three primary sources: Social Security, pension plan, if your company offers one, and personal assets. That was really the past scenario. Presently, the pension leg has mostly been replaced. Instead of pension, workers now have 401k or 403b, which are commonly known as retirement savings accounts. So, in this presentation, we are going to talk about Roth IRA and traditional IRA. So let's talk about what is an IRA, what are the types and contributions. An individual retirement account IRA is a tax advantage investing tool that individuals use to earmark funds for retirement savings. So what are the various types of IRAs? Well, as you might have guessed, there are quite a few, but we are going to talk about traditional and Roth IRA in this short presentation. So who can contribute to these IRAs? Well, for you to contribute, you need to have earned income in the form of compensation, alimony, or K1 income. Note that income from investments, your Social Security benefits, or child support does not count as earned income. So how much can you contribute and can you deduct from your taxes? Well, the amount that you can contribute is the total for both the Roth and traditional IRA. It is the lesser of 6,000 or 7,000 if you're above 50 or your earned income. The fortunate part about 2020 is there is no more age limit on making regular contributions to your IRAs, whether it is traditional or Roth. So long as you have earned income, you could be 85 years old, you can still contribute. So that takes us to your deductibility on the tax return. Are these deductible? Yes, so long as you contribute to traditional IRA. But there is a phase-out limit which is based on your filing status and your adjusted gross income. So here is a table which shows you when you are able to deduct your contributions. Again, it is for traditional IRA. If you do not have a qualified plan like a 401k or 403b, then the whole amount that you contribute to your traditional IRA is deductible. No AGI limit. But if you or your spouse is an active participant, the rules vary. If you are an active participant, the taxpayer is an active participant, and the filing status is single, then AGI phase out begins at 65K and it is totally phased out at 75K. You can contribute if your salary AGI is above 75K, but the contributions are no longer deductible. If you are not an active participant, but your spouse is an active participant, then the deductibility phase out begins at 196,000 and it is totally phased out at 206,000. So that takes us to Roth IRA, which I call the perfect sweetener. Roth IRA, the advantage is you contribute on an after-tax basis. That means you have already paid tax on your money and then you are contributing to Roth IRA. But the biggest advantage is these contributions grow tax-free and you can withdraw it tax-free so long as you meet certain criteria, which we are going to talk about in the next slide. Bottom line, Roth IRAs are an excellent source for vehicle for saving for your retirement. But of course, there is an income limit for contribution, which again is dependent upon your filing status. So for example, if your filing status is married filing jointly, then you no longer are able to contribute if your AGI is 206,000. It starts phasing out at 196,000 and it's totally phased out at 206,000. So now that you know about Roth IRAs and traditional IRAs as retirement savings vehicle, the next question is, what are the withdrawal rules? When can you withdraw? Obviously, you can withdraw when you retire because these are retirement savings account. But what if I don't want to withdraw? Well, if you don't want to withdraw, you still have to withdraw if it is a traditional IRA, and that is called required minimum distribution, RMD, which is at age 72, you are required to withdraw a particular amount. But for Roth IRAs, there are no RMDs. So the next question is, okay, I understand it is a retirement savings account and I have to withdraw when I reach 72 if it is traditional IRA. But what if I want to withdraw before that? I know that there is a early withdrawal penalty, but is there an exception? Yes, there are a few exceptions as listed here. And the two most important that should catch your attention is you can withdraw from your IRA for higher education expense, and also for first time home purchase, you can withdraw up to 10,000 without any early withdrawal penalty. So that should give you an overview of traditional and Roth IRA. Next session, we're going to talk about putting this into practice.